Welcome back, everyone. Thank you so much for joining me. Thank you for being here. Please make sure that you are subscribed to World Affairs in Context on Substack or Patreon for more and exclusive content. Follow the links in the video description below to get connected. It only takes a minute to subscribe or less, so I would love to see you there. The first U.S. bank failure of 2026 is now official, and while it might be too early to view this in the context of a systemic shock, it is a very important signal that is worth paying attention to. On Friday, regulators in Illinois shut down Metropolitan Capital Bank and Trust that was based in Chicago's River North neighborhood. The Federal Deposit Insurance Corporation, the FDIC, stepped in immediately. This is the first bank failure in the United States this year and Chicago's second in just 2 years. If this sounds familiar, that is because the process followed a well-worn past 2008 playbook. Metropolitan Capital did not collapse into chaos. We didn't really hear much about it at all. Customers did not lose access to their money, and there was no panic-driven run on deposits. Instead, the FDIC arranged a purchase and assumption deal with a Detroit-based First Independence Bank, which will reopen the failed institution as one of its own branches. So it was quick, easy, and very, very quiet. From the customer's perspective, the transition is designed to be almost invisible. It is designed to be that way for a reason. All deposits were assumed, accounts remain accessible, loan payments are still due as normal. Illinois regulators were very explicit. No depositor will lose any money as a result of this closure. So some people may ask here, well, why does this even matter? What's changed? Well, it matters because behind this calm, fake surface is a reminder of how fragile parts of the United States banking system still are, especially those smaller institutions that are operating under tighter margins and more volatile funding conditions. And as an ex-auditor who has audited many, many banks, I take this as a warning sign. At the time of this closure, Metropolitan Capital Bank and Trust held roughly $261 million in assets and about $212 million in deposits. So it was small, no questions about that. Regulators cited unsafe and unsound conditions and an impaired capital position as the reasons for shutting it down. Now, that language is very deliberate. It is very, very cautious, and it is very serious. It means that the bank's financial health had deteriorated to a point where regulators no longer believed it could operate safely without risking depositor funds. Now, the FDIC estimates that the failure will cost its deposit insurance fund approximately $19.7 million. That is not catastrophic for the system by any stretch of imagination. It is true, but it is not a trivial amount either. This is how it starts. It starts very slowly, very quietly, and then all of a sudden, they will be talking about systemic risk. Every bank failure draws down a fund that ultimately exists to protect confidence in the entire banking sector. That's how this works. What's important to note here is that Metropolitan Capital wasn't a brand new institution. It actually opened back in 2005. It existed for 2 decades, and it expanded its client base across 46 U.S. states and 10 countries. In addition to its Chicago office, it maintained a presence in New York. It looks like a small but very ambitious player, but in reality, size can be a disadvantage when economic conditions tighten, when they become worse. And this is where the broader context matters. Higher interest rates over the past few years have reshaped banking risk in subtle ways in the United States. Rising rates can improve margins on new loans, yes, but they also depress the value of existing assets, especially longer-dated securities. At the same time, competition for deposits has intensified, which raises funding costs. So for smaller banks without diversified revenue streams or large capital buffers, that combination that I just mentioned can actually erode stability. And it appears that in this case, it certainly did, to the point of no return. That erosion doesn't always show up dramatically. It accumulates over time. Capital ratios weaken, liquidity becomes more sensitive, and regulators start asking tougher questions. And eventually, the conclusion is made that the institution cannot continue safely, that it's not a going concern. This is why the phrase unsafe and unsound conditions should not be dismissed as unimportant or some boring terminology that nobody really cares about. It actually matters. It's the regulatory system's way of saying that the numbers no longer add up. And we can be sure that this bank is not the only one in the United States. There's going to be a next one. Chicago in particular has a long and a very complicated history with bank failures. Metropolitan capital is far from an outlier. Since the year 2000, 71 Illinois banks have failed, including 22 in Chicago alone. Some were small and others were not so small. The most notorious example remains the 2017 collapse of Washington Federal Bank for savings that is tied to a $140 million embezzlement scheme in Bridgeport that resulted in more than a dozen federal indictments and prison time for a sitting Chicago official. Some of you might recall that. It was a very, very big scandal. And so compared to that, Metropolitan Capital's failure is orderly and it is almost boring. But of course, from a financial stability perspective, that is exactly the point. It is designed to be that way. That's how it's intended to be perceived by the public, so as not to raise panic. Nobody wants a bank run after all, right? So it is also notable that only 2 U.S. banks failed nationwide last year. You may think that this is a good sign, but that tells us something very, very important. This is not a banking crisis moment. It is a slow motion stress test. That's what's happening. Weak institutions are being resolved individually under controlled conditions rather than collapsing en masse. Still, first failures matter symbolically, and they may be a sign of a deeper crisis. They tend to reset attention, of course. Investors, regulators, and depositors all start asking the same questions. Is this an isolated case, or is this the beginning of a trend? Well, the FDIC moved very quickly. They were prepared, and the acquiring bank, First Independence Bank, is described by regulators as well positioned to continue essential services. So the failed bank's office will reopen under new ownership during normal business hours. There is no interruption in access to funds in service, no emergency measures, no extraordinary guarantees. But the message beneath the calm is very, very clear. Smaller banks remain extremely vulnerable in an environment that is defined by higher rates, tighter liquidity, and also slower growth, and a lot of unpredictability and volatility. The system may be able to absorb some of these failures, but it certainly can't ignore them, and it certainly can't absorb systemic risk. In 2026, the first U.S. bank has already gone under. This was a very controlled, very sort of managed handoff, and that in many ways tells us more about the current state of American finance than any dramatic headline ever could. Let me know what your thoughts are on the banking industry in the United States. Are you concerned? Are you feeling pretty comfortable? Let us know where you stand in the comment section below. As always, I would love to hear from you. Thank you very much for watching. I appreciate you spending this time with me. Make sure that you subscribe, like, and share my work if you find it interesting. And I appreciate every single one of you who has become a paid subscriber. Thank you very much for your support. I look forward to seeing you here tomorrow. Take care.